Hey everybody, it's Stacie Duffy here, your Denver Metro real estate resource, and I wanted to answer the question of the differences between owner-paid mortgage insurance and lender-paid mortgage insurance. So I've gotten this question a little bit more recently from some of my buyers that are shopping around loans, because you should always be shopping around loans. I always suggest you talk to more than one lender, but so I'm guessing this is something the lenders are offering as rate incentives. But essentially what they're saying is, okay, so if you haven't watched my video about mortgage insurance, please do so. I'll put a link up here. Haven't used cards before since they took away annotations, but I'll figure it out. Essentially what they're saying is, okay, if you're putting less than 20% down on the property, so 3, 5, 10, 15, whatever, less than 20% down, the lender is saying, okay, if for some reason you foreclose on that property, there's not enough equity in it, whether it's your equity or anybody else, there's not enough equity in that home for us to make sure we're going to cover all of our losses. Because not only what they lended against the property, but foreclosure costs, marketing costs, if they have to sell it and everything else. Once you get to 20% down, they figure, you know what, if we have to take the house, we're only lending against, 80% of the value, so we can probably make it up there. But anything less than that, they're going to want insurance for if you foreclose, they want their paid amounts or what they're on the hook for covered, right? So lucky you, they're going to charge you for that because you're getting the loan. So they're going to make you pay for their insurance if you stop paying for your loan. So that's essentially what mortgage insurance is. But it seems like what they're offering now is different rates on the loan based on who pays that insurance. So there's a lot of factors in play there, but my things that I want you to consider, a lot of times the rate is slightly higher for lender-paid mortgage insurance, which means your monthly payment is going to be less because the lender is paying that insurance for you, but you have to pay higher interest on the loan. My thing is, and it all depends on the type of loan too, but for a conventional loan, that mortgage insurance goes away. Legally, it's required to go away when you hit 22% equity in the property. So if the lender is only, lending against 78% of the property value, that loan to value ratio, then that mortgage insurance wouldn't have to be charged to begin with. So, but your rate stays forever with the loan unless you refinance the loan. So some lenders are saying, okay, well, we'll pay that mortgage insurance for you. You can save the amount on your monthly payment and you can do whatever you want to with it. You can pay off the house faster, you can do whatever. But you're going to have to pay us a little bit higher rate. If you're going to be in the house 10, 20, 30 plus years, consider that. Run the numbers. Because like I said, you have to refinance. And they'll say, oh yeah, you can refinance the loan if you want to get the rate down. Well, that all depends on what the market situation is. Rates right now are really low and have been since, 2007, I guess. But these are historical 30-year rate lows, right? So what if that rate is 7% later and right now you're stuck with, something different? So you don't want to refinance to get rid of that. For the owner-paid mortgage insurance, your monthly payment's going to be higher because you have to pay for that insurance premium until you get to a certain amount of equity in the property. But once you get to that equity amount, that part of your monthly payment, that mortgage insurance will drop off. So you get to take advantage of the lower rate that they offered you. So it's kind of a trade-off situation. I say the biggest determining factor there that you should look at to run those numbers is how long are you going to be in the property? Which obviously everyone thinks they're going to be in a property for 15 years and then they call me in 5 years because life changes. Things happen. People have kids. People get married, get divorced. Grandma moves here. Mom and dad need to move in. My job changed. Things happen that you don't expect. But if you know it's going to be a temporary situation for you and you can recover most of that money up front and you're only going to be in the house maybe 3, 4, 5 years and you might sell it, maybe having the lender paid mortgage insurance and a little bit higher rate makes sense because the numbers work out better for you. But just something to be aware of. I know it's a really confusing thing. I just want to be able to explain to you and give you perspective from both sides of the situation. Run the numbers. See, okay, if you're saving this much per month, but your interest rate is this much higher. At what year, year 3, 4, 5, does it become an equal situation, and which way in your favor is it going to be before or after? So just something to consider. If you have more questions about this, let me know. You can leave them down below in the comments. Also, you can reach out to me directly. My contact information is on my website, and the link for that is down below as well. So thanks so much for the time. If you're liking my videos, please subscribe to my channel. I'm doing my best. I need some more subscribers here because I want to get a custom URL, so help me out with that. But thanks so much for the time, guys, and have a great day.